Hello everyone, I am Varun Jain from My CP Review, and in this class of Business Environment and Concepts, we will discuss about capital budgeting using discounted cash flows. Capital budgeting is the use of accounting as well as non-accounting information by the management to make business decisions. It helps us evaluate different projects when we have a limited amount of funds so as to generate returns to maximize shareholders' wealth. It deals with choosing between alternate choices, make or buy decisions, and calculating return on investment. Discounted cash flow valuation is a financial analysis technique that uses the time value of money concept to measure cash outflows and inflows of a project as of a single point of time. It is used to calculate the NPV and the IRR of the project. NPV stands for net present value. IRR is the internal rate of return. Now, these are very important and effective DCF tools used by accountants and financial analysts. Let us now understand the concepts of DCF while understanding a capital budgeting proposal we have on the board here. First component is the cost of machine, which is a cash outflow or investment. In this proposal, our cost is $90,000. The second component is the estimated future cash inflows. Here we have $42,500 flowing in per year for the useful life of 3 years. Please note that there is no salvage value at the end of the machine's life. The depreciation in this proposal is to be calculated on a straight line basis. Tax rate is 40% and the rate of return or the discount rate, also called the hurdle rate, is 10%. Do note that if a project has similar risk as the company's ongoing projects, the discount rate generally used is the company's WACC, which is the weighted average cost of capital. However, the company may use a target rate which is usually higher than the WACC. Always remember, if risk in a project is higher, the discount rate is increased and vice versa. Now, increasing the discount rate reduces the NPV or the net present value and thus avoids any misleading information regarding profitability of a project. We have a couple of points to note while using DCFs. Point number one, we always calculate after-tax cash flows, which is the net cash flow multiplied by 1 minus the tax rate. This means that for all cash flows we are estimating in the future, we need to reduce the cash flow by the estimated tax liability. In this example, our cash inflows of $42,500 need to be adjusted for tax. So we multiply them by 1 minus the tax rate of 40%, which gives us $25,500. The next point is that for cash flows, we do not use depreciation as it is a non-cash item. But friends, it gives us a disguised benefit. It helps us to save on income tax. The way it works here is, we have EBITDA, which is earnings before interest, taxes, depreciation and amortization, from which we subtract the depreciation and amortization to get to EBIT, which is earnings before interest and taxes. The interest goes off to give us earnings before taxes, less taxes to give us our earnings on net income. For accounting purposes, we stop here. But for cash flows, we add back this depreciation and amortization. But if you look at it very closely, this depreciation and amortization helps us to save on taxes. In our example, the depreciation for the $90,000 machine over 3 years at straight line would be 90,000 less the salvage value of $0 divided by 3 years is $30,000. Now our depreciation benefit or the depreciation shield as we call it would be the amount of depreciation per year multiplied by the tax rate. So 30,000 into 40% gives us a $12,000 depreciation shield. Now I have put up this mini cash flow format for you on the board. We have the investment of $90,000, that's a negative cash flow for us. or a cash outflow which is happening at year 0 for $90,000. The cash inflows, guys, we'll use the net after-tax cash inflows that we calculated 25,500 per year for the next 3 years. Next, we'll talk about the depreciation shield. As we calculated here, we are going to save 12,000 each year on the tax benefits of depreciation. Salvage value, as we know, is $0 at the end of the machine's useful life. Totaling all this up, we have 90,000 cash outflow in year 1 and 37,500 cash inflows over the next 3 years. Now, depreciation shield is not actually a cash inflow, but it helps us save on taxes, thus indirectly leading into a cash inflow. Since our cash inflows are all happening at a future date, we will have to calculate the present value of these future cash inflows. As we learned in the present value and annuities chapter, to pick up the right present value number from table extracts such as these, we need to ask ourselves a few questions. Question number 1, are the cash inflows same for each of the years? In this example, we would refer to the present value of annuity table because our cash flows are consistent over the 3-year cash flows that we have here. So it's the same amount of cash flow flowing in at the same time each year and for a number of years. If we had a vary cash flow in these years, let's say we had a salvage value year, we would need to take present value figures from the present value of $1 tables. Now, the question number 2 is how many years or for which year? In this example, we are doing cash flows for 3 years. So, in the present value of annuity table, we get to the row on 3 years. The last question, what is our discount rate? In our proposal, our discount rate or the hurdle rate is 10%. So, we look up in the 10% column and we get to our present value figure of 2.487. Now, the future cash inflow of 37,500, which is consistent for all the years, is multiplied by 2.487 to give us the present value of the future cash inflows. We get 37,500 into 2.487, giving us a present value of 93,263. So the present value of cash inflows. To calculate the NPV or the net present value of the project, we will have to compare the present value of the future cash inflows with the present value of the cash outflows. In capital budgeting, all the investment generally occurs as of year 0, as in this case. So there might not be a need to discount the outflows. The formula for NPV is the present value of cash inflows less the present value of cash outflows. $9,000 in this case, giving us an NPV of 3,263. Now, if NPV is positive, as in our case, it means that the future cash inflows or benefits are more than the cash outflows or costs. The project is profitable, the management is happy, the returns from the project are greater than the hurdle rate for the project that the management has set, in this case 10%. But if NPV is negative, it means that benefits are less than costs. The project does not have any economic value and would be a poor investment. Management certainly would not agree to it unless it has a strategic rationale. At NPV is equal to 0, the management would be indifferent to the project. The discount rate at which we get the 0 NPV is called the IRR or the internal rate of return. So at IRR, NPV is equal to 0. Therefore, whenever NPV is positive, the IRR is greater than the discount rate, and when NPV is negative, the IRR is less than the discount rate. So if the IRR is greater than the hurdle rate or the discount rate, the project is profitable, and vice versa. IRR is pretty difficult to calculate manually. It is generally calculated in MS Excel or with a financial calculator. In practical financial analysis, the key focus is on the IRR number. In case of an annuity, we could calculate IRR by dividing the present value of cash outflows by the cash inflow per year, which gives us a present value annuity figure of 2.4. Now we need to look for this 2.4 number in our annuity tables. Now if we look for the number, we get 2.402 at 12%. So IRR for this project is more or less 12%. Since 12% is greater than our hurdle rate of 10%, this project is profitable. That's why we have a positive NPV. So now you confidently walk into your CFO's office and tell him, Sam, we found this project to be profitable. It's giving us a positive NPV. Zap comes the question, what's your discount number? You see, we have taken our whack of 10%. Sam's in a rush. He says, nobody. Increase the hurdle rate to 14%. The risk in this project is higher than our current projects. Let's meet tomorrow at noon to discuss further. You walk out. All the enthusiasm is off now. You remember that the IRR was 12%, which is lesser than the CFO's hurdle rate of 14%. You still get to your desk and start redoing the numbers and find the NPV. The cash flows will all be the same. The PV number that we need to take is for 14%, that's 2.322. So $37,500 into 2.322 would give you the present value of cash inflows at 14% IRR. So 37,500 into 2.322 gives us 87,075. Now to calculate the NPV, we again need to subtract the present value of cash outflows, $90,000. This gives us a negative NPV of $2925. As I said, negative present value would mean that the project does not have any economic value. You scratch your head. This project will be rejected. I'm sure that with this example, we clearly understand the core concepts and practical application of DCF. In the first example, we saw that all the tax adjustments and the add back of the depreciation benefit. In the second example, we saw how the increase in risk led to an increase in the discount rate from 10% to 14%. Now, since 14% was less than our IRR number of 12%, we were sure even before we checked these NPV numbers that the project is non-profitable. Guys, BEC is for all the smart financial analysts or management accountants. Trust me, all of BEC is as interesting, and we at My CPA Review will make sure you enjoy as you learn to pass the CPA exams.